Uh, Assalamualaikum and salam sejahtera. Virtual meeting room in the audit firm. Senior auditor Mitran has called a meeting to discuss three complex audit case with junior auditor Palani and Haziq.
Part 1, Question 1. Seri Inspection Manufacturing Procedure and Practice.
Okay, good morning team. We've complied the initial finding for Sunny Inspiracy and the issues high account receivable, inventory discrepancies, and unsupported expenses such as heightened risk. We need to dissect the audit response focusing on the potential for misstatement, material misstatement, and fraud.
Morning, Mitran. On the account receivable front, the sudden spike is alarming. My first thought is that a spike suggests a potential manipulation of the sales near year end. To address the question, the first step must be focused in analytical procedure. We will calculate the account receivable turnover and daily sales outstanding and compare them to previous year and industry benchmarks. If the daily sales outstanding expired, it indicates a collection problem or perhaps fixation sales were recorded to meet targets. Only once we can pinpoint the high risk customer segments do we move to sending out those external information.
I agree, Palani. We must also scrutinize the sales cut-off period. A common manipulation technique is channel stuffing. We sell invoice recorded in December for good shipped in January. We need to basically inspect shipping document and sell invoice spending the last week of the year and the first week on the next to ensure sales are recorded in the correct accounting period. This directly addresses the risk of revenue overstatement.
Excellent points and cut-off and fixture sales. Aziz. The inventory issue discrepancies between physical records and the system. What specific substantive tests are key to detecting deliberate errors here and what ISA guides us?
Okay. We rely heavily on ISA 501. Audit evidence specific consideration for selected item, which mandate attendance at the physically inventory count. Beyond my attendance, we must rigorously test the client counts procedure. Our key procedure including is for the first one is test counts. Randomly selecting item from the floor to compare to the count sheet and vice versa, confirming existence and completeness. For the second is obsolescence review. Uh, Physically inspecting good for damage or slow moving signs which effort evaluating. For the third is inventory cut off, ensuring the receipt and shipment documentation is sequentially uh, numbered and used correctly to avoid double counting or commission. A significant discrepancy often point to poor control or outright inventory misappropriation.
This leads us directly to the unsupported expenses. Polani, what does the lack of documentation imply and what's the potential impact on the profit and loss?
The impact is severe, Mitran. If we can't verify the occurrence of the expenses documentation like invoices and payment proof, the expenses is highly suspected. This directly hits the completeness ascertains for the liability and the occurrence ascertained for the expenses. The potential implication is either and authorized expenses paid to an external party, or more seriously, misappropriation of cash, where a false expenses is created to cover up a thief. The financial statement would be misstated with the understated proof profit and the overstated cash balance. If the amount is material, it is a serious breach of the control that requires excellence.
Has he given all these red flags and the high account receivable inventory issues and unsupported expenses? If we find evidence of frauds, what are the non-negotiable actions under ISA 240? The auditor's responsibility relating to fraud.
The primary action is to maintain professional skepticism throughout. If fraud is confirmed or strongly suspected, the auditor must communicate immediately. This is notify management at a level above those involved, and critically, those charged with governance (TCWG). This is not optional. Uh, for the second is reassess risk. Evaluate the effect of the fraud on the audit risk and the reliability of other evidence previously obtained. We may need to withdraw from the engagement if management and TCWG do not take appropriate action. And for the lastly is legal or regulatory reporting. The determine if any legal or regulator requirement, like money laundering law, compel you to report the fraud on to an external party. We must always seek legal advice before external reporting.
Part 2, Question 2. IMA company sendirian berhad. Subsequent events.
Okay, now let's switch gears to Imar Company and the subsequent event. ISA 560 subsequent events dictates how we treat events between year end December 21, 2023 and the date of the audit February 15, 2024. We must differentiate between events that provide new evidence about existing condition adjusting and those that related to new condition not adjusting.
For the first event, the warehouse fire on January 10, 2024, resulting in 500,000 inventory losses. This is clearly a non-adjustment subsequent events. The loss causing events, the fire occurred after a year end. No condition exists on December 31st, 2023 that caused this specific loss. However, because the loss is material, is necessary disclosure in the notes to the financial statement to prevent the statement from being misleading.
Correct, Palani. That's a new condition. Aziz, the second event. The lawsuit received on January 25, 2024 regarding defective products sold in December 2023.
Mm, this is an adjusting subsequent event. The fact that the product will defective and the potential obligation to compensate customer existed on or before 31 December 2023. The liar letter simply quantify or provide additional evidence regarding the contingent liability that already existed. Therefore, the company must adjust the financial statement by recognizing a provision for the probable 2 million ringgit loss under MFRS 137 provision contingent liabilities and contingent asset.
Excellent. The root is the key. Palani, final event that bankruptcy of the major customer on February 25, 2024, leading to an uncollectible 1 million debt.
I think this is also an adjusting subsequent events. A customer bankruptcy is a strong evidence that the debt was impaired, or at least the risk of non-collection was high as of December 31st, 2023. We assume the customer financial distress was already present at year end. The company must therefore adjust accounts by increasing the allowance for impairment of the trade receivable to reflect that the 1 million debts uncollectible. Part 3, question 3. Audit reporting, ISA 700 and modified opinion.
Okay, let's finalize with the audit reporting section. Haziq, refresh our memory on the two section reasons under the ISA 700 series for issuing a modified opinion rather than unmodified opinion.
Okay, I understand for the question. I have two reasons for modification. For the first one is material misstatement. The auditor conclude the financial statement, either an individual or in aggregate, are materially misstated. This is a disagreement with management of accounting policy, amount or disclosure. For the second is an ability to obtain subsequent appropriate audit evidence for the scope limitation. The auditor is prevented from carrying out necessary procedure by management or sustainer and cannot form opinion on a material amount.
You are absolutely correct, Haziq. The severity and pervasiveness of these issues determine the specific types of modified opinion, qualified, adverse, or disclaimer. Palani, analyze Amana's Berhad going concern issue. They have substantial losses and the ability to repay loan is in doubt.
I think this depends entirely on management disclosure. If management has probably disclosed the significant losses and the resulting material unnecessity in the notes to be financial statement, we would issue an unmodified opinion with an emphasis of matter, EOM paragraph. The EOM highlights the matter without modifying the core opinion. However, if the management refuses to disclose the critical unnecessity, we could deem the financial statement materiality misleading and issue a qualified or even an adverse opinion.
Very astute, Palani. The excellent enterprise scenario management denies confirmation of AR and we can't find alternative procedures to satisfy ourselves.
Mm, okay. This is a clear scope limitation imposed by management. We are unable to obtain evidence on the existence of material asset. Since this is a imposed limitation, and the amount is material, we would issue a qualified opinion. The report would state the aspect for the possible effect of the matter described in the basis for qualified opinion section. The financial statement present fairly. If the account receivables balance we so large that we could not open on the financial statement as a was. The scope limitation would be considered pervasive, leading to disclaimer of opinion.
Okay, well, first scenario. Palani, Healthy Lifestyle Berhad refuses to disclose a major related party transaction, citing confidentially.
I think this related party disclosure are mandatory for transportation financial reporting. Management defaults to disclosure major transaction consists of material misstatement due to inadequate disclosure. Confidently is not a valid basis to withhold requirement information under the relevant accounting standard. Since this is a misstatement, non-disclosure, and assuming it's material but not purposive, we could issue a qualified opinion. If the transaction was so large or central to the company activities that its omission related to financial statement fundamentally misleading, it could require an adverse opinion.
Well, excellent discussion team. You've demonstrated a strong group of both fieldwork, procedures and the complex reporting rules. Let's document the specific ISA references for each conclusion. And Azik prepare a summary memo on the potential impact of the Seri Inspirasi issues and our overall audit risk assessment. Great work, guys.
Will do, Mitran.
Okay, not. I get that memo drafted immediately. Thank you.